Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Polito. Sharp moves in bond yields have been a key area of focus in markets to start the year. Yields on 10-year treasuries are over 1% higher than they were in September 2024, despite the fact that the Fed has been cutting interest rates. This is a historically rare occurrence in both the direction and magnitude of moves. So what's driving this phenomenon, and how is it reshaping the investment playbook compared to previous cycles? Here to help answer these questions is Jeffrey Rosenberg, Senior Fixed Income Portfolio Manager within the BlackRock Systematic business. Jeff will share his perspective on the different dynamics impacting bond yields and how his team is navigating this unique environment. Jeff, thank you so much for joining us on The Bid.
Great to be here. Thanks for having me.
So Jeff, 2025 has kicked off, and we're here to talk about the bond markets and interest rates. And for anybody who follows markets, these are important things to look at. I'm thinking back to a discussion that I had with Jean Boivin, who's the head of the BlackRock Investment Institute. We were talking about the outlook, and he said, we're in a period of time where the old playbook doesn't apply anymore. We're in a new regime. So talk to me a little bit about what's going on in the bond market, what's going on with bond yields, and why is this so atypical from a historical context?
Yeah, well, let's talk about one of the most surprising things that happened in the bond market last year, and that was that the bond overall performance didn't follow the direction of interest rates that was being set by the Fed. You had a decoupling between longer-term interest rates, longer maturity interest rates, and the shorter maturity interest rates that the Fed sets. That's typically not what you expect. And it was surprising to investors because a lot of investor expectations for bond market performance are set around what is the Fed's outlook and the Fed's policy going to be. And last year, it didn't work out. It's not the first time that had happened. I had written about this in my outlook last year, called it the potential for a new conundrum. The old conundrum was something that happened way back in the Greenspan era where long-term rates were going down while the Fed was raising rates. And we saw a little bit of that atypical behavior, but in the opposite direction. What you saw was Powell, the Fed chairman, the FOMC, they were cutting interest rates last year, and longer-term interest rates went up, completely offsetting in direction the movement that you saw in the short term. And there are a lot of reasons for that, but that was really the atypical behavior that Jean's talking about, and it carries over into the outlook for 2025. The reasons for that atypical behavior haven't gone away. They're still with us. And so when we look forward, we got to be thinking about them when we're thinking about the fixed income and interest rate outlook for 2025.
Right. And you mentioned a couple names. Greenspan, that's Alan Greenspan, who was the head of the Federal Reserve back in the 1990s. And then you mentioned Jay Powell, who's the current Fed chair. And the Fed can control short-term interest rates, but your point is that they can't necessarily control long-term interest rates. Those are going to do what they do. And the way in which short-term and long-term rates behaved was atypical, to use your word.
That's right. And usually they'll move in the same direction. But this time you had short-term interest rates going down, long-term interest rates going up. So like when they're moving in opposite directions, that's pretty atypical.
And it sounds like that's why we're in a different sort of regime, and the playbook is changing. So talk to me a little bit about what is it in the economic data that you are seeing that tells you where you think the path of interest rates are? What is the economic data telling you?
Yeah. So what's the big issue? And I think everyone listening to this understands that the changes in the economy that occurred after COVID was this incredible shock to inflation. So if you go back to the pre-COVID environment, it was an environment where inflation was really something people didn't worry so much about. Certainly people from an older generation who had gone through the inflation of the 70s, might have told stories around the fireplace. But for most of the experience, there wasn't a lot of inflation. The Federal Reserve, beginning in the 1980s, through Greenspan and subsequent chairmen, were very successful in reining in not just inflation, the level of inflation, but also inflation volatility, the uncertainty, how much it moved around, so that people just stopped focusing on it. And then in 2020. The big shock was COVID, and then two great policy responses. So the impact of federal government spending, we call that fiscal policy, and the impact of monetary policy, that's what the Federal Reserve controls in terms of setting of interest rates and other factors that they control, combined to really unleash, remember, the post-COVID environment. After we had the shock, we had a lot of growth, but we had a lot of growth where there was still constraints on the supply side, the ability to produce goods. Remember the constraints in buying things, you couldn't get certain things, the imports, the shipping constraints, all of that was kind of pushing down on supply, while at the same time as we kind of restarted our economy, we had this huge shift upward in demand. Well, that disconnect between demand and supply, that creates inflation, and prices went up a lot. We certainly know this. Now, the price changes have certainly come down. The price level hasn't come down, but the price changes have come down, but they haven't come down to that pre-COVID level environment. So when we measure inflation, we're going to measure it on annual percentage changes. Pre-COVID, that was less than 2%. Peak COVID, you were talking about 10% type increases. Now we're settling back down, but we're settling above this 2% target that people like the policymakers at the Federal Reserve like to target. Because that inflation is still not come down to that 2% level, you're seeing this disconnect affect interest rates. And it's one of the reasons for that atypical behavior where the Fed's controlling interest rates on the short end, the very short maturities that they control, but longer end maturity interest rates, they're as much reacting to what the Fed's doing as they're reacting to what's happening in inflation and, importantly, future inflation expectations. So it's in that aspect that this atypical behavior, because inflation hasn't come back down, is still with us in the 2025 outlook.
That was going to be my next question, which is why are long-term rates behaving differently than short-term rates? And you've gone back to this period of COVID and the pandemic that this is a period where we saw an inflection point in inflation. And while perhaps the increases in inflation are a little bit more tame now, they haven't dissipated completely. So is that the only reason that long-term rates then are moving higher? Or are there other bigger trends at play that you're looking at?
There are other trends as well. So inflation is a big one, but it's not the only one. So let's talk about a couple of other things that are happening in the world today that is creating this disconnect between the behavior of short-term interest rates and long-term interest rates. So another thing is what we call the term premium. Now, that sounds fancy, but it's very simple. It's basically just what's the difference in investor pricing. How much do I get paid to tie up my money overnight, cash, CD, versus tying up my money for, say, 10 years? Certainly, there's a difference in giving your money to someone for 10 years and giving it to them overnight. And that premium, that differential, is the compensation that you get for not having access to that money for that long period of time. So we call that the term premium. And historically, what we'd seen in the kind of post-inflationary shock of the 70s, beginning in 82, and all the way through the pre-COVID period, that term premium was collapsing. There was virtually no extra compensation that investors were getting for locking up their money for a 10-year period or for a short-term period. And what we've seen in the post-COVID environment is the term premium has kind of reasserted or reassessed itself higher. And there are some reasons for that, one of which is the incredible volatility in inflation and in growth that we've seen in the post-COVID environment, but just that the term premium itself had gotten to such a low level. So as that term premium is changing, it's affecting the relationship between long and short-term rates. I want to mention one other thing, which is obviously something on everyone's mind as we move into 2025 and the new administration, and what we're about to move into in terms of a huge debate around fiscal policy. But away from the short-term debate on fiscal policy is the long-term trajectory that we've been on in terms of fiscal policy. So you go back 20 years, you go back into the mid-90s, there was a brief period in time in the Clinton administration where we actually had fiscal surpluses. That's rare. We'd been running around 2% annual fiscal deficits. That's the amount each year that we're spending more than we as a country are taking in. That's the deficits. The deficit level has grown from 2% to about 6% today. And prospectively, it could grow even further depending on what happens in this coming year's fiscal debate. I mean, unlike you and I, we face a budget constraint. We can't spend more than we earn. I mean, you can, sort of add some credit cards, but there's a limit. The federal government, it can persistently run higher deficits. It can spend more than it earns, and then it borrows the difference in government bond markets. The difference today is that at 6 or potentially 8% deficits, and at an accumulated debt level. So deficits is the change. The debt, the national debt, is how much you accumulate over time. That's approaching over 120% debt to GDP. That's the way in which we measure it, a percentage of the debt outstanding relative to the size of the U.S. economy. And it's getting to points where the bond market is starting to say, hey, we're going to have to price in a little bit more of a premium for this longer term fiscal uncertainty associated with this higher level of debt and deficits. And that's a change that we've seen. And COVID really sort of shocked both of those measures. The debt, the accumulated amount, and the deficit trajectory all inflected upwards as a result of a lot of the COVID policies that we saw during that time period.
I mentioned at the beginning the bond market is such an important indicator that people look at. There's a lot of information that it gives you, and you've just highlighted it's telling us about inflation and where people think it's going. It's telling us about the term premium. You mentioned that extra premium that people are asking for to lend at longer term time periods, and then you also mentioned fiscal policy and people's view on the trajectory of where fiscal policy is headed, and the combination of all these three things is what's causing bond yields to rise. Jeff, all those comments seem very specific to the U.S. Is this the same when you look at across other world economies?
So it's really interesting when you look at the cross-global perspective, because in some sense, everyone went through COVID, and the policy responses to COVID were very similar. And we had great kind of harmonization of both fiscal and monetary policy the world over. As we're exiting the COVID period and we're seeing the changes in global country growth and inflation, you're starting to see a lot more dispersion, differences in what central banks are doing, what's the impact in their interest rates and in their bond maturity profiles. So Japan's raising interest rates in this environment that we're talking about, the Fed cutting interest rates. They face a very different environment. They had too little inflation. COVID helped them to achieve their inflation targets. They're above their inflation targets. Now they're moving to raise interest rates. Contrast that to continental Europe and the European Central Bank. Their growth environment has been much weaker in the post-COVID environment than in the U.S. In the U.S., it's a story of U.S. exceptionalism, the dynamism of our economy, partly how we dealt with COVID and the job market disruptions, partly the amount of our stimulus, and partly the strength of our consumers and the weight that consumption plays within our economy. All factor into big differentials in terms of growth exposure, but that factors into a much more aggressive outlook for the ECB cutting interest rates relative to the Fed, who's sort of saying, we're going to slow down here. We're not so sure. Maybe it'll be 2 more cuts in 2025, but much more signaling a slowing, whereas the ECB's full speed ahead. And one other country on the fiscal side, we've seen in the UK a renewed concern around fiscal policy, the ability of the bond markets to finance that debt and deficit ratios. Very different story, much smaller economy, much more global and externally financed, so a lot more sensitivity. But some of those themes about longer-term interest rates, decoupling from short-term interest rates, you see even more strongly in the UK gilt market.
So let's go from what has been a very macroeconomic discussion that you and I have been having about the bond market, inflation, fiscal policy, and if you bring it now to the investment opportunities, how do you change your portfolio construction, or how do you do things differently if you have long-term bonds behaving differently than they have in past cycles?
So I want to capture this idea in 2 aspects. First, when you have different performance across the yield curve. This concept of where you hold your duration, and duration is your measurement of price sensitivity to interest rates. Why do people hold bonds in their portfolio? It depends, but a big reason people hold bonds in their portfolio is as ballast or as a diversifier to the equities in their portfolios, a whole portfolio construction perspective. And when you're thinking about owning bonds from that perspective, now what becomes almost the most important characteristic as to how much you want to hold is how will those bonds respond if equities go down? And the point about where you hold your duration matters as much as how much duration you hold is they may respond very differently. That the long end may not respond in a down equity market scenario, recession fear, global economic shock, 10, 20%, as much as you thought they would. And it's really important to take this into consideration when building portfolios. Here's the kind of punchline. The Fed can control short-term interest rates. And if there was a big enough shock, the Fed's likely to respond to that and want to bring those rates down. But if they're doing that at a time like we have today, where that inflation side of the mandate hasn't completely been won, then it's potential that you might have the long end of the curve not react favorably to the Fed basically saying, we're going to preference our growth target here over our inflation target by cutting short-term interest rates. Well, when you're holding a bond portfolio and you're holding it for ballast, you're going to want to hold the ballast part more in the shorter end of the curve. You're going to need more notional to do that, so that creates some challenges from portfolio construction perspective, but it helps to concentrate where am I thinking about I want to hold my bond portfolio when I'm thinking about it from ballast terms. That's kind of one aspect. Second, quickly, I also want to think about the components of my portfolio in terms of the components that are driven primarily by the directionality of interest rates. Are interest rates going up or interest rates going down? What I was just talking about. And I want to separate that from the earlier thing we were talking about, which is opportunities investing in dispersion, investing in differences in interest rates across different geographies, countries, central banks. And what's really kind of exciting about the opportunity set in 2025 is that the dispersion opportunity is growing. And generally what we see is when the beta, when the directionality component, when that becomes more challenged, it's an environment where this cross-country, cross-government, cross-central bank perspective starts to increase in its opportunity set. And then what I can do is I can weight my portfolio. How much do I want to have in the beta and the directionality aspect? How much do I want to have in this kind of cross-sectional aspect? Right now, we want to be increasing that cross-sectional aspect because the opportunity set is growing and it reduces our reliance on kind of getting the forecast of the direction of interest rates correct. I don't know, maybe you're going to ask me that next is my question. Where are interest rates going? We'll give you a forecast, but I don't want to make the entire portfolio performance dependent on that one forecast. We want to diversify our opportunity set.
I have to say that oftentimes people will describe the bond market as being a little bit boring compared to all the activity that goes on in equities. But Jeff, in listening to you, there's a lot going on in the bond market. It's conveying a lot of information about inflation and fiscal policy and growth and interesting investment opportunities that are arising. Jeff, thanks for sharing all of that color about your outlook, and thanks for doing it here on The Bid.
Great. Thanks for having me, Oscar.
Thanks for listening to this episode of The Bid. Next week, be sure to tune in, where we discuss thematic investing, an investing trend that focuses on identifying and capitalizing on long-term themes expected to shape the future. Subscribe to The Bid wherever you get your podcasts.